Welcome to This Explainer. Okay, we're jumping right into a comprehensive stock analysis of Novo Nordisk by passing it through our rigorous guru gauntlet. We are putting on our expert investment analyst hats today. We're not just glancing at some basic charts. We are stepping directly into the shoes of the world's absolute greatest investors to fundamentally value this pharmaceutical titan, all based on its latest financial data.
Here's how we're breaking it down. We'll evaluate this obesity care giant using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Then, we'll run it through modern DCF and comparable models to reach a definitive verdict.
Section 1. The Company Snapshot. Before we can apply any of our frameworks, we need to know exactly what baseline facts we're dealing with today. So, here is our current reality. Novo Nordisk trades under the ticker NVO. The stock is sitting at roughly 326.90 Danish kroner. That's about $50 USD, which gives it a truly colossal market cap of approximately 1,289 billion DKK. They're pulling in a diluted earnings per share of 23.03 DKK, and the headline here, this company is the undisputed heavyweight champion in GLP-1 treatments, commanding a massive 59.6% volume market share. But the million-dollar question is this dominant company actually priced to buy?
Section 2. The Warren Buffett Lens. We're looking at moats, management, and margins.
To answer if it's priced to buy, we have to start with the Oracle of Omaha. Buffett wants a dominant business with incredible economics, a deep economic moat, and honest, shareholder-friendly management. Novo's moat is practically a fortress, holding a staggering 59.6% market share in the global branded GLP-1 obesity market is just incredible. Buffett loves a monopoly or a duopoly, and in the obesity and diabetes care space, Novo's brand power and their massive distribution scale create a structural advantage that is going to be incredibly difficult for new competitors to breach.
And they easily check off Buffett's primary financial criteria, too. I mean, look at that astronomical return on equity of roughly 50.4%. The company generated 102.4 billion DKK in net profit against 203 billion in shareholders' equity. Debt, highly manageable. They have 146.3 billion DKK in long-term debt, which they can easily cover with their massive cash generation. Plus, management is actively returning all that excess capital to shareholders with a 50.7% dividend payout ratio and a brand new 15 billion DKK share repurchase program.
Finally, for Buffett, we have to look at owner earnings. That 28.3 billion DKK figure right there represents Buffett's approximate owner earnings, which we derive directly from the company's 2025 free cash flow. This gives the management team incredible capital flexibility. Honestly, Buffett would absolutely love this business, but as we all know, he demands a strict margin of safety on the price, so he'd very likely wait for a pullback before pulling the trigger.
Section 3. Let's shift gears and look through the Peter Lynch lens, focusing on categorization and growth.
Lynch famously taught us to invest in what you know, but he also taught us to strictly categorize companies so we know exactly what to expect from the stock. Lynch would likely categorize Novo right now as a stalwart transitioning through a cyclical dip. On one hand, you have serious elements of a fast grower. Their Q1 Wegovy pill launch completely smashed estimates, pulling in 2.26 billion DKK. But on the flip side, you have the heavy reality of a stalwart. It's got a 1.28 trillion DKK market cap, and management is actually guiding for a 2026 sales contraction of -5% to -13%, mostly due to fierce pricing pressure in the US market and some patent expiries.
What's really fascinating here is what happens to Lynch's absolute favorite metric, the PEG ratio, which divides the PE by the growth rate. The trailing PE is actually really attractive at 10.5x. But because that forecasted 2026 growth is negative, the PEG ratio effectively breaks down. It's undefined. Plus, assuming heavy institutional ownership given the massive 94.13% free float, Lynch would definitely view this stock as being a bit over-discovered. His verdict? Well, he'd likely hold off until the whole growth narrative stabilizes and they get past those current US pricing headwinds.
All right, Section 4, the Benjamin Graham lens. Time to run the defensive investor checklist. Graham's mechanical valuation tests are notoriously strict, especially when you apply them to modern pharma companies that typically trade on future pipeline promises rather than current book value. But remarkably, Novo passes almost his entire checklist for the defensive investor with flying colors. Adequate size? Absolutely, it's over $1 trillion DKK. Strong financial condition? Yep, cash reserves easily handle the liabilities. They have fantastic earning stability, a solid dividend record paying out 11.70 DKK per share, and a moderate PE of 10.5x. This just goes to show its fundamental, rock-solid underlying business quality. However, the math gets tough when we calculate Graham's actual intrinsic value formula. When we multiply his base constant of 22.5 by the trailing EPS of 23.03 and the book value per share of 45.65, and then take the square root of that whole thing, we get an intrinsic value of exactly 153.8 DKK.
So the takeaway here is pretty stark. At 326.90 DKK, there is absolutely zero margin of safety according to Graham's strict asset-based math. The stock is trading at more than double its intrinsic value. Graham would almost certainly pass on this stock at its current premium. He'd categorize it as way too expensive for a true defensive value investor.
Section 5. DCF and comparable models. The gurus give us the philosophy, but now we need the raw mechanics of forecasting cash flows.
Let's build out our base case DCF. We start with the actual 2025 free cash flow of 28.3 billion DKK. We have to use a short-term growth rate of -9%, since that's the midpoint of management's own 2026 guidance. Now, to fill in some missing data, we made a few logical assumptions. An 8% weighted average cost of capital, which is the standard for large-cap pharma, and a 2% terminal growth rate, just to mirror perpetual GDP growth. When we project these cash flows out and discount them back to today, it gives us a base case fair value of roughly 210 DKK per share.
Of course, it's always smart to run a sensitivity analysis to see how the valuation shifts if our assumptions are slightly off. But notice the overriding trend here. Even under the most wildly optimistic assumptions, like incredibly low capital costs of 7% and a high 2.5% terminal growth rate, the absolute maximum fair value this model spits out is 295 DKK. Meaning the math just struggles to justify the current 326 DKK price tag based purely on cash flows.
But wait, valuation doesn't happen in a vacuum, right? Looking at comparables, there is a totally stark contrast. Novo trades at just a 10.5x trailing PE. Meanwhile, its arch-rival Eli Lilly trades at roughly 36x earnings. That is a massive 3.4x multiple gap. In fact, it's the widest gap between these two dominant GLP-1 names in over 5 years. So, relative to its biggest peer, Novo actually looks like a massive bargain. And that right there explains why so many analysts remain highly bullish.
Section 6. Synthesis and Final Recommendation. Let's see who actually survived the gauntlet.
You know, Wall Street is deeply fractured on this stock. The market is completely split right now, with analysts targeting anywhere from a super bearish 175 DKK all the way up to a highly bullish 440 DKK. It entirely depends on how they weigh the incredible potential of that new Wegovy pill against the very real, immediate threats of US price erosion and generic competition.
But summarizing the fair values from our gauntlet, the frameworks actually tell a highly consistent story. Buffett and Lynch both signal a hold. They recognize it's an incredible business, but the price and near-term growth narrative just don't align for a buy today. Graham signals a hard sell because there's absolutely zero margin of safety based on book value. The DCF base case values it at around 210 DKK, confirming it's fundamentally overvalued right now. The single flashing green light we have comes from the comparables versus Lilly, suggesting a buy based strictly on that massive relative discount.
So blending all of these expert insights together, our final recommendation as investment analysts is a firm hold at the current price of 326.90 DKK. Look, the business itself is phenomenally strong. You simply cannot ignore that 60% market share or a 50% return on equity. But that impending 2026 sales contraction introduces just a bit too much short-term risk. The guru's criteria heavily suggest waiting for a pullback. A drop closer to 210 DKK would finally align with our intrinsic DCF fair value and give us that vital margin of safety required to trigger a strong buy.
I'm going to leave you with this provocative thought to ponder today. As an investor, are you willing to pay a hefty premium today just to own a piece of that massive economic moat? Or does the strict discipline of the margin of safety demand that you sit on your hands and wait out the 2026 pricing headwinds? It's a really tough call, but hey, that's exactly what makes a market. Thanks so much for joining me on this explainer.